Welcome back, QuickBook users, and in this lesson we're going to look at something called unearned revenue. So we're still in this thought process of whether we're using the accrual basis or the cash basis. So if we're using the cash basis, we're just focused on when cash comes and goes. If we use the accrual basis, it depends on when something's actually getting used or actually getting earned. And since we're talking about revenue, let's think about an example. Let's say we have a client prepay us to do some landscaping. They prepay us $1,000 for landscaping work. The cash basis says we got the cash in our pocket, so it's revenue. But that's not really realistic. If they prepaid you $1,000, you have to provide them with something. You owe them landscaping work. And when you owe something to someone, then that's called a liability. That's called an obligation. And we need to reflect that in the business. So one of the weaknesses with the cash basis, it doesn't reflect the obligations from customers that prepay us. We'll first look at how we would go about recognizing the revenue under the cash basis if we got prepaid for a landscaping job, and then we'll look at the accrual basis. So we'll go to sales, all sales. We'll do a new transaction, a sales receipt. We'll use a customer. We'll just use the first customer on the list, and we receive cash, and we're going to consider it undeposited funds because we received the cash but we haven't put it anywhere. And then the service is landscaping. They're paying us $1,000. So using the cash basis, this is going to be recorded as our landscaping revenue. However, if we're using the accrual basis says that we need to call this unearned revenue until we actually do the landscaping. So we're going to go to new and do a journal entry. So we want to show the receipt of the cash. So we're going to put this in the undeposited funds. The customer's putting $1,000 in our hand. And then we want to show the liability. We call it unearned revenue. Now we haven't used this yet, so we're going to have to add that account. So how do we set the account up? We want to use the account type other current liabilities because it's current because the customer's paying us for landscaping and the customer wants it within a year. And so if it's less than a year, it's a current liability. And the detail type is the same. And the name we're going to call unearned revenue. So we're going to save and close that. And so now we show that we received cash. So that's going to be nice to show on our books. But we haven't done the work yet. So we do have a liability, an obligation. So unearned revenue has the word revenue, but it means that it's not revenue yet. It's going to be revenue if we do our part. So we'll save this, then we'll show what happens when we do some of that work. So say at the end of the month, we've done some of the work. So now we want to reduce the unearned revenue by the amount of work that we did. Since unearned revenue is a liability, we reduce liabilities with debits. So let's say we did $200 worth of work. So we reduce the stuff that we owe them. The unearned revenue is what we have, what we owe them, and since we did $200 worth of work, we're going to reduce it with the debit. And then we're going to recognize the revenue. So we'll put it under landscaping services. And so this is going to now show that we've done $200 worth of work in the month that we're in. So that's the revenue that we earned. So that's the revenue we're going to count. This is what we do when we use the accrual basis. On the accrual basis, you only show the revenue when you earn it, not when the cash is received, but when you actually earn it. The first method we looked at was the cash basis. And the cash basis is a different type of mentality, it's a different type of methodology. But a lot of businesses don't like the fact that they're showing the revenue even though they haven't done their part. And if you think about it, they owe that customer some landscaping work. When you owe some work to the customer, you haven't earned the revenue from the customer yet. So the revenue is really kind of mismatched with the time period. Again, whether you use the cash basis or accrual basis, you would you would be consistent. So if you're using the cash basis, then you would always recognize your revenue and expenses based on when the cash comes in. You wouldn't do some things under the accrual basis and some things under the cash basis. But since those are the two options, we needed to look at those two options so we could compare them and understand how we accomplish those depending on the way the owner and the manager wants to run their business.